Rate cuts are just the first domino to fall, and what happens next may surprise you.
Well, there's a lot of central banks have been cutting rates, right? So we're kind of the last.
Right. So we actually do have data. And as you guys know, the Fed meets this week. We are pretty sure they're going to be cutting rates at least a quarter point. Some people are saying a half a point. But either way, interest rate cuts are coming.
I know. A lot of people single-family realtors are hanging on every word here.
Well, you say that, but it really is a lot of people are hanging on rate cuts. I mean, everyone I'm working with is really excited about them. Saving a couple $100s a month on a mortgage is exciting for people. I mean, it is.
I can't deny that.
Yeah.
I can't deny that. But like I will, a quarter point. Well, first of all, we haven't dropped rates till December last year. So it's been a minute, right? It has not happened in 2025, even though Trump's been beating on Powell the whole time, and he's going to get those rates down.
He is going to get the rates down, and I think that what is interesting is you really have to look at this as a change in the whole narrative, right? So Powell's been very hard on, inflation, focusing on inflation. Now the focus will be on economic growth, right? Because we have a stalling job market, and Powell is going to flip this a little bit because he has to and kind of get these jobs going. But, growing the economy is inflationary.
Right. I'll tell you that, there's always two sides to everything, right? Like, so if you're in the mortgage business or the title business or single family or, real estate specifically, I guess, or autos, you want rate cuts. Right. There are other consequences to it. It definitely is going to stimulate the economy.
Yep.
There's no question that lower rates, cheaper money, make people finance stuff more. Period. Right. Mm-hmm. So that's not necessarily a bad thing, but that also creates price inflation. Yeah,
you're going to have inflation. We already have these tariffs coming. All of those things.
Right. Even without the tariffs, when you historically, if you cut rates, that's when we we see runs in things, right? It's cheaper and doesn't happen. There's a lag, right? It doesn't happen immediate. So the question would be how fast is this going to happen? It sure looks like he's going to slowly let the line out through next year. And by the way, I think Powell's still there till May of next year, mm-hmm. and then nothing's really going to happen significantly immediately, right? Even when he steps down.
Well, and I believe that the hearing for Lisa Cook is actually today to see if Trump is able to replace her. I think they did an emergency order, so that will also be interesting. But we all tend to focus on the wrong things sometimes, right? So people focus on interest rates and how it's going to affect housing. And Ken, like you said, it's only a couple $100 difference on like a, $400,000 or $500,000 mortgage. But the other thing that interest rate affects is the savings rate, right? And there is right now a record amount of money, $7 trillion sitting in money markets now.
That's the other piece that mm-hmm. I was going to tie into. There's always there's two sides to this, right? So there's a lot of money sitting in savings and in treasuries. And the other thing that a lot of people don't think about is George Gammon talks a lot about this. Jeff Snyder talks a lot about this. It's called the euro dollar market. The euro dollar market is quite directly it's just U.S. dollars outside of the U.S. That's it. Now, the interesting thing is it's a very, very big market. It's bigger than the U.S. market. So, and why is that? It's because we pay for goods and services with U.S. dollars. So why is this important, and where am I headed with all this? Well, if you're holding U.S. dollars and just kind of leading into what Danille was just talking about, then the price of those dollars actually goes down. Right, because again, if the savings rates go down, so there's historically there's usually a sell-off of U.S. dollars as rates go down outside the U.S., which does what it does is it actually drives the price of the U.S. dollar down even more. Now, as you guys know, I think we were up this year. We were up in over 100, like 110 on the DXY. If you don't follow the DXY, you probably should. The U.S. dollar is an important indicator. And before the podcast today, I looked at it was 97.24. So it's low as compared to historical averages. And so with a sell-off, we could actually see the U.S. dollar actually get weaker as well, which is not necessarily good. But on a lower interest rate, if you're buying real estate, refinancing real estate, buying a car, financing whatever, it makes sense. If you have a lot of consumer debt, it makes sense. It's definitely going to stimulate the economy.
Well, what you have to remember, too, is when all of these investors have money in the money markets and T-bills and things that get negatively affected when you lower interest rates. Because when you lower interest rates, you also lower those savings rates. So not only is a mortgage a little bit cheaper, the money they're saving is worth a little bit less. So it kind of doubly hits them, right? Because one of the things about the housing market right now, and one of the reasons it's stalled, is investors typically aren't in the housing market yet. They're waiting for those numbers to work. And the more mortgage rates go down and the more rents go up and the less savings rates pay, the more investors are going to get off of the bleachers and start, reinvesting in real estate and other assets. So, you can't just look at, housing's still unaffordable for people that, make a salary. You have to look at the $7 trillion. If they're not making the money in the money markets, they're going to want to invest it. If inflation starts to ramp back up, they're going to want to invest it into hard assets that move with inflation. So all that money, as it starts to come off of the seats, is going to affect all of these markets.
What's up with the bleachers?
I don't know.
I love it. No.
Just riffing here.
Oh yeah. Listen, that's awesome. I one of the things that we were chatting about this weekend as we were getting ready for this was what happens when rates go down somewhere else, right? Because they have been, the central banks, guys, we're the last one to the table here. That's why Trump is kind of pissed. If you just look at rate cuts, they've been happening in most countries this year. But one of the interesting things is that when that happens, there's a lot of cash buyers.
There is.
So this is an important thing. This kind of made my head twist a little bit. So you should explain this. Yeah.
So we kind of focused on Britain and the UK because they, started cutting rates in August of 2024, right? And so far, it was a quarter point, and then within the last year, they've dropped it 1.25%, right?
So 1.5 basis points in a year.
1.25, but yes. So what did it do, right? Because that's very similar to what's going to probably happen here, is a gradual reduction over the next year or so. Well, the property market is stronger than it's been in 3 years in Britain. Transactions are up 18% this year. Mortgages are up 6%. So if you have transactions up 18% and mortgages up 6%, that means 2/3 of your buyers did not need a mortgage to buy, meaning they bought in cash.
That really surprised me. So think about this. If you guys are sitting on a lot of cash waiting for rates to go down, the indicator here was the people that were selling their house. Because the people that were buying, there's a lot of cash buyers. And I was thinking, why is that? Why is there a lot of cash buyers as rates go down initially? Because right now, as you guys know, when we led with this, is there's a lot of cash right now sitting at, what was it, $6 trillion?
$7 trillion.
$7 trillion in cash. Okay, so when rates start to go down, then the people selling are feeling more comfortable with being able to make a move. So it really affects the sellers. So the first wave that comes out of the box is the cash buyers, and these lower rates are going to help people on the other end.
Well, I'm working with a buyer now. She was an investor, and we're going to look at properties, and I put her in touch with my mortgage guy, and we were doing all that, and then we found a house, and she's like, I think I might just pay cash for it. And I'm like, oh, okay, so you have $600,000. Yeah, she does, right? Because people do. I mean, people that are investors, they have that money and they're sitting on it, and they might not even want to get a mortgage, or they might want to get a mortgage, but either way, 2/3 of the transactions in Britain, who's done a very similar thing as us, which is kept rates high. They lowered them sooner, but now that they've lowered them, you have a lot of investors coming into the market. But the other interesting thing that Britain's doing, which I think we had talked about last week, is they are setting up programs to get first-time buyers into houses.
Yeah.
So
this is coming. I'm
Yep.
telling you guys, this is coming.
So Britain has we already have the policy that they're putting into place, but that doesn't really matter because the point is that they want first-time homebuyers into housing. So what they're doing is they're allowing first-time homebuyers to put 5% down, which before it was much higher than that. So because of that, 54% of buyers last year were first-time home buyers.
So I think this is important. So I obviously knew this, but just say that one more time because this is over 50% of the buyers.
Over 50% of the buyers, 54% are first-time home buyers.
With this new program.
Yep.
And I'm telling you, obviously, our government, other governments, they look at playbooks just like a governor looks at another state. What the central banks have been doing in other areas, in some cases, have really been working. And this is one of those programs that is definitely working.
Yeah, absolutely. And so, we were talking about 40-year mortgages last week because Trump keeps floating that idea. And irregardless of what you think of it, it makes it easier for people to get into homes. They did something similar in 2008 to get people into homes, or not, I'm sorry, not 2008, like 2003, when they made it 0% down to get into a mortgage because everyone deserved a home. But what that does is that gets more people, but it gets more people buying. So when you have more people buying, you have prices that are going to go up.
This is the risk. This is that I'm glad you brought that up. That was the precursor to the GFC. So the great financial crisis. So again, if you take a look at what rates have done, all you have to do is just go look 3, 4, 5, 6 years out. Because what happens is initially there's all this activity and then it starts to go up, the pricing, and then the rates go down because as prices go up and rates go down, the monthly mortgages are not that different. So you're buying more house at higher prices, but your mortgage payment's not changing that much. So think about that. So as your rates go down and your home price goes up, the consumer doesn't see, and I know I'm generalizing here, but the reality is if a price of a home goes to $300 to $350, and the mortgage payment or the mortgage interest costs go from 6 to 5, the consumer doesn't see that much difference, even though they're paid $50,000 more for the house. And so this is the beginning of that. And then in 2008, as you guys know, it popped. And so this is this is for sure what the Fed's concerned about is depending on what you do, and the president historically, they don't care. The president, they look great if the economy's buzzing and people are buying stuff, and the Fed's job is to create that resistance because they're monitoring both the unemployment and, among other things, and of course, the inflation rate. And inflation largely, I guess, has come back to earth, at least the reported numbers, right? Although the PCE came out, it was a little high. The consumer consumption, I can't remember. Anyway, I was looking at the PPI. That's the PPI. The producer price index, which is the components of, to the manufacturers, let's say. The CPI is what we see, but the PPI is something that hits the businesses. And again, I'm generalizing, there's more to it, but that's an indicator typically to the CPI. There is some concern there. And also, we know, we haven't really talked about tariffs yet. We know that there's a lag there.
Absolutely.
Right?
Yep. Now, one thing I do think that is interesting right now in the UK is even though, transactions are at their highest in the last 3 years and a whole bunch of new home buyers are entering the market, prices have not went up that much. prices have stayed pretty stagnant. So you have transactions going
Yeah.
up, but price is not going up. And that, I look at that to be similar to what could happen here, right? Where maybe you don't have a run on prices because it's not like 2020 where there's such an increase in demand, but you have it where, it's a more balanced market. It's not a buyer's market. It's not a seller's market. It's a more balanced market.
And I'm just going to go out on a limb here and tell you guys, if I had a crystal ball, what I see in the next year to two. If you look at Trump has historically wanted and pushed for and gotten lower interest rates. Okay, so as a real estate investor, if you're buying today, all cash, or you're buying today and the rates are a little higher, what that means for you, it means that you can also refinance over a period of time and get your payment lower each time. So what you're going to want to do is you're going to want to make sure that you don't have these big prepayment penalties and all these things that are built in so that you can switch out the loan. So you're going to want to be really, really paying attention to the fees that you're giving or you're paying for, some of these lenders and things like that. And that's the key here. What you want to do is if it makes sense financially and cash flows today, you got to get into the game here. And then if rates do go down, then you just refinance on the way down. And if prices go up, because they may or may not, of course it depends on the asset class, depends on the market, then you can, what you can actually do, and this is, Ross and I did this, is you can actually scoop that value tax-free, because a cash-out refinance is tax-free. It's debt. So as prices are going up and rates are going down, what you can do is you can harvest the equity, so you can get back your investment. And that's the whole key here. There's a lot of times, I would say novice investors don't really look at cash on cash. The next level up, what they do is they look on, cash returns, cash on cash. How much return am I getting on that cash? And the smarter ones and the professional investors, they look at when am I going to get that cash back? And so that's the ultimate. If I can invest tomorrow, the next day, this year, and I can actually get that cash back and still own the asset, not by selling it, but by getting a cash out refi, we could be at the beginning of a little run here. Now, obviously things have to go well, but if Trump gets his way and rates start to go down, you're going to have this window of time to be able to buy things, but you're going to want to buy things that you're not funding. You want to make sure they're cash flow, that your tenants pay you the bills for you. Make sure that happens, please. Because if things stay the same, then you're fine. So buy today, make sure it cash flows today, but then if prices go up and rates go down, this is the time, guys. This is the golden time. This is the first inning or two.
Yeah, and so a lot of people on YouTube are asking, what if they lower rates, but then, nothing happens with the actual interest rates? So if the Fed lowers rates and nothing happens, they do not believe that it's going to.
Yeah, well, then you're still fine. Like, you know what I mean? Mm-hmm. Like, yeah, I mean, that absolutely could happen, right? Gosh, like, the reality is that that's why today, as you guys know, we've been really active. I think we're going to do 8. We have another deal closing this week. So we'll have 8 transactions this year. That's a lot for us, and I think that we're somewhere in the north of 600 million this year we've done, all based on yesterday's prices. And we're not even talking about the interest rates yet. Like, I've done all that, and the rates haven't gone down since December of last year. So I've done all of this based on where I think it's going to head. It might not. Like, the rates might not. It's possible. But I'm telling you, if you just look at the president who's been in office before and what he's done before, my guess is that you could see that. But the key is buy it today, make it make sense today. Please do not buy based on a price going up. Please do not buy based on an interest rate going down. It needs to work today. If it works today, it'll work tomorrow. And then if And if rates go up, you're hedged. If rates go down, then it's like sitting at a slot machine. Literally just pull that handle, or on the bleachers, pull it on a slot machine. So I think all you got to do is just do that. And then what will happen, just like everything, when cheap money comes out, is the pricing of real estate will go up. As the rates start to go down, trust me on this, guys, it happens. It's not necessarily good, but it will, because if prices are going up and rates are going down, then the consumer is going to see, they're not going to see much difference, because their mortgage payments, they're solving to their auto payment, they're solving to their mortgage payment, they're solving to their credit card payment. You guys know, that's how this works. They're not really focusing on the price or even the interest rates in a lot of cases. That's why people get caught up in these really bad high interest rate issues that they have. They're looking at their monthly and they get duped. That this is in my opinion, this could be the beginning of an incredible run here for the next couple of years.
Yeah, absolutely. So
what? Oh, yeah. And we need a moment from our sponsor here, Monetary Metals. Near all-time highs, but appreciation isn't the only way to benefit. Monetary Metals, you could potentially earn a yield on your gold, paid in physical gold, without selling it. Here's how it works. When you lease your gold through their platform, pre-qualified companies pay to use it under strict guidelines, like renting out real estate, but with gold. Instead of paying to store your metal, you may earn up to 4% annually in gold. You stay in control, and you can choose which leases to participate in. Monetary Metals handles the due diligence, lease terms, and all the administration. Thousands of investors use this approach to grow their gold, not just sit on it. Visit monetary-metals.com/Ken to learn more. Leasing gold involves risk, and returns are not guaranteed. This is not an offer to buy or sell securities. Please review all risk disclosures at monetary-metals.com. Visit monetary-metals.com/Ken to learn more. Hold on.
So the other thing, though, for those wondering if rate cuts are not going to happen if the Fed lowers rates, we haven't seen that yet. So, so far we have seen rates drop almost a quarter point, just because mortgage companies like to kind of be ahead of the curve. So if they think that the Fed's going to drop rates, they tend to do it a little bit early to try to drum up some business. So we are seeing that rates already have been cut. If you go to get a mortgage now, you are down to the lowest rates we've seen in years. It's like right around 6.3.
Right. And I think it's probably good to just wrap up the show with some information around the stress between the renter and the home buyer. So we've done plenty of data around this. You guys saw that Buffett made a huge investment into a lot of homes, and their costs are down because of all the rate incentives that they have to do, and they're jacking that into the mortgage costs. And so home prices are down in many areas, and a lot of you are saying they're up in my area, which is totally fine. But of course, this is not a singular market. There's a lot of things happening right now, and generally listings are starting to pile up a little bit, and all that's happening is it's just becoming normal. Well, what's also not normal is the renter market, which is the market that that I play around mostly in. And what's happening in the renter market is that rents are soft. There's concessions. So the renter right now, they get a lot of love. Because a developer has hundreds on a brand new property. They might have hundreds of apartments to rent, and this is a result of the low interest rates. By the way, back to these interest rates again, that we had just a few years ago. So these apartment complexes that you guys see, these cranes that you guys see in the skies, that all started. No one's really significantly building when interest rates for construction is 8 and 9%. I'm just telling you. So the stuff that you're seeing now is hitting the market. It's creating a lot of supply, And what that's done, it's good for the renter. So we have this really disproportionate time frame that we're looking at, where we have price of homes high and interest rates, by a lot of people's opinions, high. Even though I personally have done extremely well in 5 and 6% interest rates my whole life, to a lot of you, it's extremely high. But what we really have is we have a huge difference between the renter, the rent, and the home buyer. And so what's happening is there's a lot of people moving over to the rental side of the equation because they can't afford a home. That's about to change. And so that's going to actually put more pressure on the rental side of the equation if we start to see these affordable housing programs. If rates start to go down, you're going to start to see people that are going to move back over to that home buying side. And in my opinion, there needs to be a good balance there. And right now, there's not. Right now, we're moving into what I would consider to be a renter nation, which is not good. Because I personally, and we talk about this, we don't want the youngsters, call it the 20s and 30s, to not be able to ever buy a home, because that is where most Americans they hold their wealth. The rentals are supposed to be a stair step, to build credit and to save and be able to buy a house. That is a healthy market. And so I'm hopeful that we don't roll right into this, what we just went through in 5, 6, 7, 8, which I was right there alongside of it. And in 2004, 2005, 2006, 2007, the home builders were going crazy. The interest rates were pulling people out of the rental market. It was an extremely hard time. This is 20 years ago. To be in the property management and the renter business. And so, we could be heading back into that again. And the other thing to note, just to finalize on this last point, is during 2000, and we'll call it 2022, 2021, even late 2023, people were building apartments and building single family and all that stuff because rates were low. Those are now done. There's not a lot of new product that's been hitting the market in the last year to 2 years because the interest rates are high, because the developer looks at it just like you would. So the developers pulled back. They might still own the land. They might have got the deal approved by the city, but they just pulled back. They said, we're gonna hold this out because the cost to build a house, the cost to build apartments has gone up too for us as a developer. Well, that's about ready to change, because all the stuff that I just talked to you about, as people move from the single family over to the rental, it's called absorption, and those units are absorbing, and we're starting to see now rents at about zero or flat, and they're actually even rising in some markets, and so that means to me that rents are stabilizing right about now. And we're going to start to see rent growth, maybe not significantly this year, but certainly a little bit next year. And then it's off to the races. In 27 and 28, it's not going to be good again. And you're going to see this glut time frame. And what will happen? You're going to start to see a real rise on the rental side of the equation. So, that's the other piece when you start to look at rates and how it affects the whole picture.
Yeah, so essentially what you're saying, that if buying a home gets a little cheaper and rent gets more expensive, then the gap is smaller than it is currently.
That's right, yeah. And so just to summarize from the bleachers.
For those of you that have ADD that, spaced out there for a second.
Was that you?
Yep. So... But anyways, thanks for tuning in, and we'll see you guys next week.
We'll see you guys. Bye.